Ladies and gentlemen of the crypto space, we're live on a Wednesday, January 29th at 11:34 a.m. We have up on the screen the dollar, and my first post this morning was the good old dollar junk kick maneuver as the dollar ripped above 108. Got these maybe a little misleading on the daily chart, so we could take them off. And you have the 10 SMA just above. So it's clearly a compression between the 10 SMA and with 50 SMA. We'll try to keep my monologue short. Well, let me preface the entire stream with that. If you're on X or on YouTube, please feel welcome to ask any questions. We talk in great length on Discord and X about a variety of topics, not just crypto. We talk about law and taxes and whatnot. So please feel welcome to chime in, ask anything on your mind about any topic, and we're happy to cover it. So there's an interesting compression between the 10 and the 50 SMA on the daily chart. I'm not too fond of the daily chart. It's too short term in many regards, but there's a long way to go on the weekly chart. So the way my mind works is we look for what's most constructive in the shortest time frame inspectable. So we don't have really an MA inspection on the weekly chart. 50 SMA is all the way down at 1047. We do have the level, but the level is also available on the daily chart. So the most meaningful chart to inspect is the daily chart from a DXY standpoint. And obviously we could zoom the fuck all the way out and look at the 6 month chart. And now we're talking about the inevitable destination. But this tells us where we're at today. Today's FOMC at 2:30 Eastern. That will get the markets cooking. It always gets the markets cooking in one direction or another. So at least we have a time today where we get a little bit of movement in the markets rather than just doldrums and complacency and just so many folks capitulating. Now, anyway, this behavior of the 10 SMA to me is quite constructive. This is the first time you have to go back to like a breach, but it just ran up so quick in September of 24 that from a daily perspective, it's quite elevated compared to everything throughout all of 2024. You'd have to go back prior to, you'd have to go back to probably the top year in 22 to start to get some sort of inspection of where we are. But that's also interesting. Coming off such a run up in the value of the dollar, we're looking back to 22. What the hell happened after 22? Well, at the end of 22, Bitcoin stabilized 23, and it took till 24 for all coins to basically go on two runs. All coins require a general sentiment of stability in the markets and collateral valuations. So the remonetization of broadly Bitcoin, a good part of Ethereum as well, um, is what led to these two bull markets in the DeFi space in 2024. So if we're looking at this as a potential top, 22 is probably my inspection of comparison. And aside from that, look at where the lows are relative to the 50 SMA, and we did breach the 50 SMA to the downside. So generally speaking, this congestion is to me an expression of a topping pattern. You have a breach of the 50 SMA, you have a decline of the 10 SMA towards the 50 SMA. This is the closest encounter of the 10 SMA to the 50 on the daily chart since September of 2024. Um, so this is where we are. This is the conversation we're having today about where we are today. Now that obviously is always amidst the backdrop of where will we be tomorrow, and where will we be throughout 2025. I don't want to digress too much into big duration conversation. Folks are feeling a little complacent today. It's understandable. Um, but the FOMC, I'm certainly looking forward to the afternoon session and the way things head. into the rest of the week. We could take a look at Bitcoin being over $100,000 is absolutely insane. What a remarkable price. Now, I come from a bias because I remember the good old days. I know Bitcoin from significantly cheaper prices. So these numbers are astounding. For folks that are getting into markets now, they're like, all right, this is the price and this is their point of reference. But when your point of reference is Bitcoin at what cycle top 2018, um, 19, $20,000 or earlier, three, four, $500, these numbers are surreal. So when I see these numbers of over $100,000 for Bitcoin, I'm like, everything else is noise. Bitcoin has been monetized. Oh, the dollar rolling over, everything just gets further monetized. And the best is yet to come for the fintech part of the crypto space. Bitcoin is not necessarily fintech, but that's maybe a subtle conversation to have. Curved out at 69 cents, punching 70 cents, but from a moving average standpoint on the daily chart, it's 100 SMA mean regression. So what is the order of moving averages? 10, 50, 100, 200. Very simple inspection. I'm not a trader, so this gives me a general sense of the overall structure of things. If you have strength and support here, still a position of weakness, but all right, fine. This is by definition what a mean regression is. Price came back to an average price, the 100-day average price. That's interesting. That's constructive. Frankly, it's a great deal comforting considering the dollar being at 108. 108 is going to put a lot of pressure on the international community, international foreign nations. And we've had conversation in great length about what it does, why it does what it does, and why the administration's policy and China collapsing all contribute to a confluence that suggests the dollar is going to go freaking lower. Because if it doesn't go any lower, none of this works. None of this system works. It all falls apart. It's a very simple equation. Dollar up, everything is done. The rules based order is done. Dollar down, all right, everything continues. So then the question is when you know the why, the how is probably interesting. I've heard a couple of macro folks speculate on the how. I've heard Raoul talk about the how, and the how could come in many shapes or forms. Maybe, NGOs bid yen, bid yuan, maybe swap lines. Uh, Interest rate policy is a complexity because you go up, things fall apart internally. You go down, things potentially also fall apart internally. So I don't know how these fuckers at the Fed do their job. That's impossible. I don't think any person should take that liability or responsibility. That should be automated, deterministic. So it's software. So it's predictable rules where it establishes fairness, a level playing field. Everyone knows the rules. Not waiting for 2:30 p.m. for them to tell us what their decision is, their choice on how the future of the financial system is going to work. Fuck that. Anyway, so frankly, if they raise rates, and I posted that yesterday, if they raise rates, I think that would stabilize the shit out of markets because that increases the Japanese U.S. interest rate spread. That encourages more international investments into the US. And as you narrow that spread, if Japan raises rates, which they did, and the US cuts rates, which I would say they really shouldn't do, that would narrow the spread. If you narrow the spread, that's going to, in time, increase the value of the yen. That will mean paying back debt in Japan is more expensive. So if you have to pay back and it results in something more expensive, that means if you were going to make $1,000 profit on a carry trade, now you're only going to make 800. That's why the carry trade unwinds, and that is all a matter of the spread, the difference in interest rates. So the entire role of the regulatory authority of all nations and all central banks is to suppress volatility. So they want to make that manageable. So they're trying to do it slowly instead of completely collapsing the interest rate spread between Japan and the US. That would be a complete, utter chaos of the carry trade unwind. Volatility would spike through the roof. They have no capacity to move these damn interest rates, in my opinion. They just can't do it. So my expectation is probably they do nothing today. And they're like, oh shit, maybe next time we do 15. We're fine, a quarter percent. Oh, but if they lower the rates, you collapse the spread. Those guys are screwed. If you don't lower the rates, I mean, look at the housing market and mortgage demand, which has collapsed at 2015 level. No one's going to get more. Maybe if people did get mortgages in the 70s, 18%, big mortgages. Maybe that doesn't work at the inflated housing price. But the point is, you lower interest rates, you encourage mortgages. If you don't, status quo prevails, and that's kind of screwed from a residential and especially commercial real estate perspective. If you raise rates, that just makes that situation even worse. But that, on the other hand, increases the interest rate spread between the US and every other damn country around the planet that is cutting rates. The US had the balls to raise interest rates, the amount of foreign investment. Now, unfortunately, that foreign investment historically heads to bullshit in boomer meme coin markets, equities markets, stock market, NASDAQ, S&P, so on and so forth. So it's malinvestment. Why? I don't know. Administrative policy, regulations, shitty investment landscape in the US, albeit it's probably the best investment landscape in the world. Thus, why we've had so much capital inflows. Anywho, so that's some thoughts around, do they not hike rates? Do they cut rates, which would probably be negative on the economy, or do they raise rates, which would actually increase risk market appetite, further financialization? Um, Gold's at insane levels, right at the top. I think this is probably the biggest signal through the noise. Bitcoin is center stage around the world, but gold is further center stage. So this tells us something very meaningful with regard to the way people think. People think that currency supply around the world is going to expand. Oh, and they need more confidence in the assets that they hold for savings purposes, for collateral purposes. And that is what gold is, historically has served as, and will continue to serve as. So this is telling us what people are thinking about in the future. If this continues to go up, if we break all-time high and you get a nice leg up, 2,800, 2,900, 3,000, that tells us a lot about not just what people are thinking, but what corporations and central banks, which means what nation states are thinking. Well, that's a big deal. So move was at 85, popped to like what, 95? Yeah, give or take. Back down to 92. Relatively low volatility. What, a third of a percent? I mean, that's what it was when Japan hiked. Maybe it was less than a percent on that day, or was it? May have been higher. Mi- Was it 1.8%? Anyway, so that was could account for move popping like it did. But when you see like a daily move of the 10-year yields at 0.3%, I suspect if that holds, we would see bond market volatility indicators roll over. And as bond market volatility indicators roll over, that's something that the world looks at this point. I look at this point. That tells us everything about the potential for the dollar to go down, because as we all know, this is what I talk about, as bond market volatility collapses, that is a forward-looking indicator of the capacity for the rest of the world to increase currency supply. Let's go through some comments. I remind you all, if you're on X or on YouTube, please feel welcome to ask any questions. Crypto, finance. Um, Too few folks ask about business structures and whatnot. I still like that topic. Always fun. Out a sec. Good morning, Cap. Here for my rationality dose. Yes, indeed. Cam's in the house. Good morning, Cap. Twice a week. Twice in a week. My man. Always a pleasure. Arrow. Good morning, my friend. Usual De Silva. Good morning, Filippo. Hi, Cap. Analyzing Tango. I keep thinking if it's too good to be true, it probably isn't. I did some deeper researching on the team, which reinforced my feelings. Any thoughts on this? Uh, well, they're not paying out of thin air. So that is something that is reinforcing of the product, potentially independent of any sentiment regarding people. Um, it's not like they raised millions of dollars of Bitcoin, Ethereum, and USDC, and they're just, Ponziing it out in yield to lockers or stakers. So that yield is coming from the activity of the protocol. And it's a very simple inspection to see the activity of the protocol. That was 2 days ago at 470 mil open interest. Is it down? 460 mil? It's got 400. If you're at 10x leverage, which I don't think you are in the looping mechanics, it's not a perp exchange. So if you're at 5x leverage, you're talking about $92 million worth of deposits on average 5x leverage to get this kind of open interest. Um, that's insane for a protocol that is less than $5 million market cap, and that is my position. It What else is there to look at? Tremendous amount of open interest, and not fudging open interest. These are the deposits, and that's the leverage, or rather, from the open interest, which is the leverage, you could speculate or infer the potential deposits, which are tens of millions of dollars in an asset that has a market cap less than five. My 2 cents on Tango. Couldn't Tango. Connect the dots. Good morning. Much a pleasure. Do you look at M2? What do you think about this metric? It's boring. We're talking about the United States capital. Um, I'm much more interested in thinking about the total currency supply of the world. The United States is only a small part of the world. Clearly, it's a large component of world metrics. I don't really care about M2 too much. I don't even have it. Yes, I do. All right, I do. And it's so misleading. Folks don't understand the huge run up. But the good part, this is a lot of credit card debt, and this is an expanded form of U.S. currency supply, as manifested by what the components that create this chart, which is leverage, everything on top of M0, not bank deposits, because that's ultimately leveraged also. So, we're really talking about M0 is a good inspection. And then, it's like Mike Howe's work. He infers global currency supply, or mm, liquidity, as he defines it, as a capacity for the world to refinance. And that is what facilitates the continued existence of global currency supply and the speculated expansion of global currency supply. And that's where the move indicator comes in, because when that thing rolls over, that is the precursor for the global currency supply to expand. Last I heard him speak, 270 plus trill in global dollar liquidity. I don't know, is it up at 300? 270 to 300, let's say. Let's round it to 300. So if you got $5.6 trillion in existence that totally exists, all the amount of dollars that exist, and there's 300 trill in available dollar liabilities, which is our global currency, um, I find that constructive, because we've deflated, or we've deleveraged the system quite meaningfully. Notice how M0 is the M2 is a manifestation of market activity and behavior of people, whereas M0 is clearly Treasury Department. So here, let's zoom in. Why the hell am I zooming out on all that noise? So we have effectively deleveraged the global financial system 12.72%. That is massive. Well, I take it back. Let me say this again. Let me say this again because this is an important thing to get right. Up is deleveraging. When you increase currency supply against a global liability backdrop, this was a deleveraging. So between 2019 and end of 2021, we doubled the amount of current base currency that allows the global currency supply to exist. This was the deleveraging. This is designed to contract global currency supply by saying, all right, these are the amount of dollars that back global currency supply, and that shit went down 12.8%. So doesn't necessarily contract global currency supply as we see the behavior of markets. And there's a lot more that goes into the behavior of markets. It doesn't immediately cause a contraction of global currency supply. And even if it does, let's say it's 5% contraction of global currency supply, you still have the capacity of the system to concentrate capital, meaning money moves from one market to another. And that is governed by a very simple principle of capital moves to where it's best treated. Capital moves from underperformance to outperformance. Pretty simple. So if other countries are doing poorly and the US is doing better, you clearly get this funneling of capital into US markets, potentially amidst the backdrop of a decreasing global currency supply. Now you can look at global M2. That's a part of currency supply, but you still have, the dark pools or the Eurodollar market, and that's really an inspection of global bank balance sheets and their asset to liability balances and how many liabilities can they print or need to print to balance their books according to double entry accounting standards. I'm not too sure what happens with M0. That's Treasury policy. And once again, it's policy. It's not like it's deterministic. This is all policy of people in boardrooms making subjective decisions. And that is an interesting takeaway that they chose to deleverage the shit out of the global currency supply significantly. It's a 100% increase in M0 between end of 2019 and end of 2021. Um, Anywho, bit of a digression, but I hope that explains a little bit of M2, M0, and how I think about the significance of that data. Harvey, do you think Jay Powell will stick it to Trump and go hawkish on all of us? Well, hawkish, if they raised rates, financial markets would stabilize and likely expand. Most of the social media talking points don't understand the mechanics. And according to my understanding, if there was an emergency 25 basis point rate hike by the Fed, markets would stabilize and likely expand. Cutting rates, that's going to narrow, you know, U.S. Japanese interest rate spread, and that's going to encourage deleveraging of capital that was borrowed in Japan to invest in the United States. So the stock market, the stocks sell, dollars go to yen, strengthens the yen because they got to pay back debt in more expensive yen. So as the yen goes up in value because they're increasing interest rates, that is what increases the odds of a deleveraging. Or if you narrow the interest rate spread, that decreases the amount of return. So, all right, instead of five, let's say 4%, whatever the spread is, minus the insurance and currency swap fees and whatnot. But now instead of 4%, it's 3.5%, 3%. So all of a sudden, the carry trade starts to be unsustainable because you're only in a carry trade if it's profitable. Once that profit gets eaten into, or it becomes unprofitable to keep open, you close a position. I don't know how many folks play with perp exchanges or leverage, but these are concepts that are important when engaging in markets like that. Except that the difference is this is done at the tune of hundreds of billions, if not trillions of dollars, and you're dealing with trades between actual countries instead of the aggregate of people and countries instead of just one little person using a perp dex. Anyhow, that's my 2 cents on what I expect to see no change today. I think uh, I think they're screwed whether they raise or lower. So I think their safe bet, the only safe bet they have, is to actually do nothing. Albeit if they're that's it's an interesting way you phrase it. Stick it to Trump hawkish. If they raise rates, that'll cause markets to do well. They'll never raise a quarter percent. So the best they could probably do is nothing because the general public won't understand why you're hiking rates. That's going to make mortgage costs and credit cards more expensive. It's just the problem is social media doesn't talk about the mechanics of a carry trade and interest rate spreads and why would you have a carry trade open and what is the relative price of currency due to these types of positions. So it's not that cutting interest rates all of a sudden makes markets go up at all. That's not how it works. That's not the mechanics of it. Angelo, hey. For taxes, you thought about migrating to a country with simple tax regulations, maybe even thought specifically about Cyprus. I stay here. I'm good where I am. There's been a lot of content on YouTube. I mentioned this on Discord the other day about like LLCs, S corps, and whatnot, and insurance products. There's a great deal of strategy to create sophisticated entities to it's not you don't mitigate tax obligations. Taxes are always due, but you follow the rules, and the rules are there. You could read the rules about insurance products in an S corp or a corporation, and adjusting basis based on um, uh, the structure that is created, and it's not like these are secrets. This brings me back to maybe a reality that everyone doesn't see. You don't even have to use AI. You could go on Google and find the rules. Like here, let's check it out. Florida uh, tax law, tax foundation, Florida revenue, state of Florida tax guide. All right, great. Florida trust law. Oh, look at that right at the top. That's convenient. So it's you don't even need AI. It's like it's right here. Here's the rules. Now, obviously, AI changes everything because otherwise this will take 6 months to read through, yet alone understand. But, you know, the US still is a nation of laws. And what reinforces that and substantiates that is the separation of or equal rights for each of the branches of government. Why does that substantiate the US as a meaningful place for laws? Because every branch of government wants power and they want to stick it to the other branch of government and say, no, motherfucker, you can't do that. So the judiciary says, oh, no, I interpret the rules. So the executive could say, and that's exactly what happened this past weekend with some executive orders. The judiciary said, no, no, hold on. And that's cool. And Congress does what it does. But the judiciary is pretty cool because those boys are, when they're doing their job, which they do because they have great power in their job, they appreciate the law and the words. So the U.S. is a great place in that regard. And there's a lot of laws because it's not just the federal government, it's the state government. And the states all have different laws. So you literally could come to this country, such an itch, and choose, pick a state, pick from 50 different sets of laws that have 50 different effects in federal consideration. And that's where the 10th Amendment of the Constitution comes in, which is like pretty cool. The power is not delegated to the United States by the Constitution or prohibited by it to the states are reserved to the states. So basically, if the federal government doesn't have a rule, states make the rules. And it's not like that is the federal government can rule on everything. There's a battle. So just like I said, equal amounts of power for each branch of government. The states also have that too, and the states fight for their power. So the federal government says, "Oh, we're going to make a rule about this." The states are like, "No, no, 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 no. We haven't done that in 200 years." That goes to the states, and frankly, based on the sitting administration, it's a whole lot of federalism in what he talks about, and I find that quite interesting. Um, like disaster relief and FEMA going bye bye. It's like, all right, we'll pay the states, and the states are the best to administer their own disaster relief. Or the controversial Roe v. Wade and abortion, he pushed it back to the states. So federalism is lovely, particularly because there's arbitrage potential, meaning there's 50 states. Just go to another state, one, two, move, and you could choose 50 sets of laws. Consider that's crazy to think about. And each state has unique considerations, unique powers, and they offer unique things. Anyway, hope that helps. Mitch, how are you? What will drive 10-year to go down since more? I know where you're at. So 10-year will go down if well, the market sets the 10-year, which means interest rates, and that's the fallacy. The fallacy is that the federal government, the Federal Reserve, sets interest rates, and it's not how it works. So 10 to 30 year long duration debt is what sets interest rates on what sets the interest the reference interest rate for interest rate products, particularly mortgages, credit cards, and what have you. So this is market driven. Uh, the extent that the Federal Reserve has influenced interest rates, the ones that we consider when engaging in financial activity, is quantitative easing and quantitative tightening, which is either that buying or selling treasury instruments, or any of them, bills and bonds as well, the whole yield curve. So they've been quantitative tightening, which has been raising rates. And I still believe they are quantitative tightening as well because they're selling debt into the market, decreasing the price of the 10-year, which increases the interest rate. Whether they do QE or not is separate, in my opinion, from where yields will head in the short to midterm. If you zoom out, I suspect this is a topping pattern that's relatively similar to the dollar. And they're all connected. There's a reason why I have move on the right, 10-year on the right, and the DXY on the right. So it's a very interesting level, and it's a lower high. And I think it's topping, and I think we fall down probably to, let's say, 2.5 to 3.5. This is a log chart, so that's why it seems like a large spread. But I think generally the trend, unfortunately, is interest rates going up, higher lows, higher highs over the next decade. So 2.5 to 3.5, which coming down from four, whatever it is, or whatever the prevailing interest rate products are, I expect interest rates to come down. Um, Probably in the short term, which is anywhere between 1 to 3 years, something like that. Um, If interest rates are coming down, that's because 10 to 30-year treasuries are getting bought. Now, there's a whole lot of considerations and why those kinds of instruments would get bought. But generally speaking, if you see interest rates come down, it's a market driven rate. That means the price is going up, which means the price of collateral is going up, which means the move indicator is going to roll over, which means the dollar is going to roll over, and which means financial markets are going to go absolutely ballistic. The dollar is probably the single most meaningful inspection to understand when risk markets go absolutely parabolic. Here's your two legs. These are your bull markets in the crypto space. We'll bring it back to crypto. Thanks, Mitch. Um, People have talked about this. It's lore, it's legend, or whatever the hell people want to call it. 2017 to 2018 was one of the greatest bull markets in the crypto space. 2020 is famous for DeFi summer, and that ended with a double rip in Bitcoin into the end of 2021. We must bring it up. There's your double rip in Bitcoin, easily inspectable on the dollar chart. So aside from all the other things we look at, which I look at primarily because they're like forward-looking indicators, it's like, why is the dollar here where it is? And I get a great deal of information from the move indicator and 10-year interest rates. Tells me, all right, the dollar's probably going to roll over. Like if you see move collapse to 75, 70, 65, the dollar's going to roll over. And there you go. You're off to the races. See move spike. The dollar's probably going to find the bottom in a quarter of a year, 1 to 3 months. And here's your bull market activity in 2024. There was a bit of a frenzy in the crypto markets two times in 2024. And that's because the dollar had meaningful legs down. And right about now, this is the monthly chart, more constructive as we started the stream to look at the daily chart. It looks like we're in a decent topping pattern, looking at the 10 SMA versus the 50 SMA, and then drawing a little bit of hindsight from October 2022, or rather, Q4 2022. Anywho, I hope that helps. Um, I don't expect too much relief in interest rates for consumer interest rate products, particularly mortgages. On the other hand, supply and demand dynamics could indicate depreciation, uh, forced selling. If there's big liquidations or capital is required, and you have a $500,000 property and they're getting liquidated, they need to sell it for four. It's just get it out the door. So, and we're in Florida. I don't know. There's a whole lot of content on YouTube about the collapse of shit in Florida, and plenty of other considerations in property. These are personal choices, but imperative to inspect elevation. Here in Florida, absolutely do not buy anything in a flood zone. No, no, no. And a bit of a distance from the shore, you got hurricane considerations. I mean, if you're 30 miles from the shore, like Miramar, Weston, Pembroke Pines, it's just Miami Gardens, those are great areas. You're on the west coast of South Florida. So that means you're protected by 100 miles of Everglades. So if anything comes from the west, there's no flooding. Still, you want to be considerate of flood zones. And if you're from the east, all right, you're probably not going to get flooding, especially if you're not in a flood zone. And hurricane damage you have 30, 40, 50 miles of buffer for it to drop from a Cat 5 to a Cat 3. Buying a home in Florida. Anyway, I'm just digressing. But, hurricane windows, that's an investment. Absolutely need them. You need to make sure you have decent landscaping with grading. You need the grading. You need the earth surrounding the property needs to grade down to street level because you chose not a flood zone. So the water goes away from the property and goes into hopefully sewer system in an area. Now in Florida, you'll notice the man-made lakes. So a lot of the communities, if you look on Google Earth or Google Maps, you'll see between Weston and like Miami Gardens, the communities, they're all surrounding a lake. So Florida pumps the water out of the lake in preparation for hurricanes. Um, so that means the communities are built, so the water goes to the streets, the water drains into the sewers go into the lakes, and the lakes are pumping into canals, and those canals are pumping into the natural lakes or the Everglades or what have you. Florida is so misunderstood for hurricane preparation. You would think a state like this would be prepared. Now, obviously, you got a whole lot of shit towards the east. You go east. I mean, the coast is pretty good. The big towers, they build them solid. But between western South Florida and the full East Coast, A1A type stuff, you have the old properties, old Florida. That's not built good at all. Pure flood zone across the board, which is where most people live, and that best is said to be unfortunate. Anyway, my man, I'm getting back to work soon. I promise. Yeah, Levy. Liquidity asymmetry is launching a bold fork on mainnet. Talks about accumulating CDX protocol owned liquidity, and in the future, rev share using VEASF. Um, Anytime governance power is accumulated, it's powerful, especially as this market expands over the coming years. So that's cool. I'm not interested in speculating on a new investment. I find asymmetry interesting. I find liquidity interesting. And I mentioned maybe last week a position was acquired, has depreciated a bit. Whoopie do. But I like the product that liquidity has produced. There's going to be a lot of good products. Liquidity looks like it is well built and interesting from a feature set perspective. I find other dollars quite interesting as well. Obviously, CRVUSD, obviously money by DeFi.money. And there's going to be a lot of products that are interesting in the coming years. Hope that helps. What are the pine cones? Good morning, Cap. Thoughts on our current journey through the business cycle? So, business cycle's dead. Business cycle is gone. Some indicators I've seen seem to suggest that we're in the middle of a business cycle uptrend. What is the business cycle? You know, IWM, purchase orders. It's IWM, right? No. Yeah, purchase managers index. I'm looking at all the wrong tickers right now. Listen, that's all driven by available capital. If a company can acquire capital, they're going to expand. I mean, demand by retail is not going to expand. Retail is under the gun by inflation over the last 3 years. Probably about 30% of people's capital post 2020 has evaporated to nothingness. So the demand isn't necessarily coming from retail, but you know, manufacturers, retailers, and the whole business system is forward looking. And as they build, they're thinking about where demand will be in the future. So, you know, Raul talks about this the best, and he has his forward-looking inspection from a business cycle standpoint. But the business cycle is only as interesting as currency supply is available, and currency supply is not available as long as the dollar is as high as it is. At least that's from an international perspective. But that plays into everything because if you're in one country versus another, you assuredly know your interest rate or your currency spreads. Um, so as the dollar weakens, that allows foreign manufacturers to do what we just discussed. That makes their foreign currency go further, and that is really the start of the global currency supply expansion. Global currency supply expands. That encourages manufacturing, and then come the incentives for retailers, and that plays into everything. Think about all the stuff we get from credit card companies. Why do you think we get them from credit card companies? It gets retail folk to engage in financial activity. These are all incentive systems. You always have to reduce everything to what the incentive is, and you'll understand why behavior is either changing or occurring at all, considering the real estate market where it's not occurring. The wealth effect caused primarily by ever increasing real estate prices is an important component of a truly frothy market. Balancing interest rates with the real estate market seems important. They'll never be able to balance the interest rates with the current situation in the real estate market. The real estate market is overinflated in principal valuations, and for folks to afford these property values in the areas where people are choosing to live, um, interest rates would need to come down significantly. Now, this could lead to geographic trend changes, new population centers. People are moving in very different ways, going to different states, rural becoming urban, becoming cities. It's a whole dynamic thing to potentially consider. You can't just drop the interest rates. You're going to blow up the carry trade. That's my 2 cents from the Fed. They know that. Record low real estate sales at the moment, though much of the US and North America, for that matter, wealth effect not in effect. Yes, that is the case. Real estate shouldn't be a damn investment. What a tragedy when the system started incentivizing that behavior. It is what it is. I'm sure everyone will have their opinion in hindsight, whether we have some sort of financial complexity or not. I don't suspect one way or another. Florida is great as long as you're living 1 hour from each coast. Yeah, I thought about it a lot. And the west coast of South Florida is crazy because you got 75, which goes right across about an hour to get to the full west coast of Florida. I'm not talking about when I say the west coast of South Florida. That's the little chunk of land on the right side of Florida. You're an hour from there, and you're basically about an hour from the beach. Also, considering the fucking traffic, that's another story. It seems today's post-market tech earnings will be illuminating, much more so than Fed notes, all things equal. Tech is hyperinflated, obviously. Mag 7's crazy. Nvidia coming back down to earth. It's not like there's justification for Nvidia coming back down to earth. It's literally just a reason. That's how bear markets start really quickly. Because when something's hyperinflated, folks, just give me a reason. Tell Give me a sign to sell. And that's exactly what happened this week. Folks just needed this microscopic reason for that shit to roll over, 10, 20, 30%, whatever the hell it's at. Let's take a look at the chart for the fun of it. Literally a 200 SMA mean regression on the daily, and folks are freaking out. Let's see if it holds or not, but that's another story. But it's really surreal when you see these mean regressions saying, all right, what do you do? It's a 200 on the daily. What about the weekly? Oh, yeah, it's a 50 on the weekly. Oh shit, it's a 10 on the monthly. I mean, it's literally just a mean regression. I would look to the 200 as the stronger, and it's a shorter term. Maybe it cascades into the weekly, but this is a mean regression so far. I always like to show folks if you look at the 6 month chart on Nasdaq, here's your mean regressions. I mean, obviously this goes back to 1999, but look, mean regression, 2020. All that shit about financial collapse, and it was literally a 10 SMA mean regression on the 6 month chart. I mean, it was a massive dip. You don't get mean regressions like that on the 6 month chart with it being small. But if you zoom in, mean regression to the 50, 22 was a mean regression to the 50 also. Weekly, 200, hmm, 200 mean regression in March of 22. Decent mean regression in 18. Uh, Nice little breach to the downside in 22. Mean regressions are a funny thing. Folks' sentiment about prices going down are a funny thing too. Strange the way humans think. The number one way to succeed is to take what you think and realize most of it's wrong and be like, how do you force yourself or train yourself to think a different way? Is that a topping pattern, the DXY, or is it a test to flip resistance to support? Oh, dear Lord, don't scare the crap out of me. Now, we're about to find out, man. We are about to find out. Got a little bit of resistance on the 10 SMA on the weekly. Let's go into the daily. Resistance of the 10 SMA. Nice smush between the 10 and the 50, as we mentioned earlier. But this is a hell of a line. This line right here, this level, is truly significant. If you zoom out to the monthly, this was the level set back in 1976. And maybe I'm drawing it wrong because I'm not even drawing it at the top of the wick, in which case, doesn't make much of a difference. We're a bit above at 107.9, and the top of the wick is probably 107.5. So a couple hundredths of a point. So maybe. I don't know. We'll find out soon enough. Athletic Concept President accounted for. Sir, yes, sir, yes, sir. Era, my wife doesn't want to learn how to manage all my crypto stuff, voting, claiming, selling, what to do. Well, first reality, this will be the last question, folks. First reality is that is an awesome place to be, which means there's something worth managing. That's awesome. Second, I don't have the answers. You would think, let's say you're an investor, hypothetical, and you have 100 grand and you make it 30 grand a year because that's the cash flow. You would think that folks would be like, oh, I need money. How do I get it? Let me learn how to get it. I have to click buttons. What do I have to click? Why do I have to click it? To get the damn money. I mean, what what we've built is a capacity to click a claim button because of things we own, and the things we own are paying us. That's income, cash flow. It's not necessarily income. If it's in the trust setting. That's another story. But it's kind of a big reason or an incentive to want to understand. So I would strongly encourage um, just the reality that money's important, and without it, can't buy things. So I don't know. I don't have the answer to that. Um, I think all the time, and I have prepared till I'm exhausted, exhaustively, for if I'm not here. So I would say, don't stop, Arrow. It is not an option. It is a requirement. Bring up the kids. Do what you must. Skip the third parties. I have gone back and forth with third parties, and I've had like legal opinion letters, and I'm tempted to get some more third party information. But I'm like, you want something done right, do it yourself. So I don't like third party money managers. So I'm not too comfortable even saying anything like that. So I would put the burden obviously on yourself that it's not a matter of convincing. It's a matter of it's a requirement. It's a no brainer. This is the money. It's everything. It's how you survive. That's how you live. You have to understand how to manage it. So you try your best, because it would be a damn shame. It'd be a damn shame if it evaporates into nothing. And anyhow, it's a digression. There's a little bit of subjectivity in the commentary, but I think you get my point. I hope it helps. Ladies and gentlemen of the crypto spaces, Wednesday, January 29th at 12:29 p.m. We got a little FOMC action at 2:30 p.m. Maybe we'll see the markets actually move rather than looking like they're dead or something. So let's look forward to the afternoon session. 295 people made it to the end of the stream. I appreciate each and every one of you. And together, we are all a little bit more rational because of it. I will see you guys later this week. Until then, peace.